Welcome to Daybreak Australia. I'm Haidi Stroud-Watts in Sydney, where markets have just come online.
I'm Annabelle Droulers in Hong Kong. We're counting down to Asia's major trading opens and the top stories this hour. Asia set for a weaker open ahead of key US inflation numbers. Fed officials emphasising data will drive the pace of interest rate cuts.
Earnings in focus in late US trade, with Paramount sales falling even as streaming subscribers beat the street. Snowflake melting down after its forecast misses estimates.
Plus, Bitcoin topping $60,000 as ETF-driven demand triggers a bull run.
All right, let's get you straight to the start of trading this Thursday session as we get that staggered open just creeping online when it comes to Sydney stocks coming online now. We're seeing a little bit of a flat start to trading. Broadly speaking, we're looking like a bit of a retreat being set up going into the Asian equity session. Both treasuries and the dollar strengthening the session ahead of the Fed's key inflation metric. That's expected out on Thursday, and one of really the biggest data points to watch in terms of how much this would potentially continue to impact repricing around Fed expectations and when that easing will ultimately come. Here in Australia, we're also watching some of the commentary from the Australian Treasurer, Jim Chalmers, isn't ruling out that the economy potentially shrank last quarter. Speaking to G20, I should say, counterparts, he's saying that the fourth quarter GDP number was likely quite weak. Economists are expecting about a 0.2% rise in that data due out on Wednesday. But there are some concerns that the Australian economy really weakened quite significantly going into the final 3 months of 2023. That potentially also then plays into expectations for the RBA rate increases and how much of that elevated inflation picture played into that. Remember, the inflation reading that we had yesterday, the CPI reading, actually was a little bit softer than expectations. The Aussie dollar is really trading sideways at the moment. 64.96 is what's happening, despite a little bit of strength that we see in the US dollar. Switching it out to take a look at the setup when it comes to Japan, and this is a picture as we look at the start of trading in Tokyo. We've got about a tenth of 1% higher, I should say. Pretty flat at the moment as we get into the start of trading in the JGB market. We're watching for that auction of 2-year government bonds in the session today. Dollar yen firmly above that 150 level, again, where we're looking at potentially a little bit more verbal jawboning expected from policymakers there. We're seeing Kiwi stocks a little bit on the back foot after the RBNZ decision yesterday, Belle.
Yeah, and Heidi, as you said, it's really just this waiting game we've got for the key US inflation print that's coming up in about 24 hours. But here's the picture we get for US futures as they come online here. Again, a little bit of weakness creeping in, so similar moves to what we had in the intraday session. What traders, as I said, they're really awaiting that key US inflation print. Ahead of that, we actually had a revision downward to the US GDP at the end of last year, but that data kind of seen as pretty much uneventful by a lot of investors in the market. Still, though, as we said, this core PCE reading could really highlight just the very bumpy path that the Fed faces to achieving its 2% inflation target. What else we're tracking in the session? You can see Bitcoin here, really that asset we've been tracking over the course of this week, up more than 60,000 or past that 60,000 mark. It actually earlier touched nearly 64,000, again, overnight in the US session here. It's that supply-demand dynamic. There's more demand coming through, given investors are piling into these spot Bitcoin ETFs. That's rising faster than the supply that can be issued into the market by Bitcoin miners here. So that's really just the trading setup in the session today. But it is, Heidi, really that focus on the Fed that we're really also tracking in the session. What we've been hearing from Fed officials.
Yep, inflation and Fed speak, right, Belle? And as you say, these officials have been out in force, repeating that the pace of rate cuts will depend on incoming economic data, suggesting that the path to lower borrowing costs may look quite different to previous easing cycles.
Back in December, my colleagues and I put out what we call projections or forecasts, and the median was for 3 rate cuts this year in 2024. We're data dependent. We're going to watch the data. I'm going to watch the data. A sign of success to me is that, with inflation coming down and the economy so strong, that we can, be thinking about doing that, I would say, later this year.
Makers carefully assess the evolving data and outlook. I do want to see more evidence of that sustained trajectory. And consistent with projections from FOMC participants, I do believe it'll be appropriate to begin easing policy later this year. And when that happens, a methodical, forward-looking approach to gradually reducing rates should provide the necessary flexibility.
Let's get more reaction on that now with Carol Schleif. She's CIO at BMO Family Office. And Carol, I'm interested. We've had bond markets really digesting this sort of feeling or thought that the Fed would be staying high for longer until the end of the year. Equity markets, though, have had that huge run-up and perhaps a bit more driven by earnings. But do you think that that Fed narrative has been fully digested at this point in time?
Well, let's hope so, because the Fed's has given us that narrative for a very long period of time, and they've been very consistent in the messaging, saying higher for longer, no rush to cut, and both as a group in terms of FOMC meetings and Chairman Powell afterwards, and then all the individual governors have been telling us over and over and over again that higher for longer was going to be necessary, number one, and that number two, the path to 2% to getting to their target number was not going to be a straight line down, and we're definitely seeing that in the data.
But given what we are also seeing in the data, do you think it's possible, the economic resilience we've seen, that this sort of no landing scenario also comes into focus?
I think it definitely does, because we haven't necessarily seen a slowing or a vast pullback. Our expectation coming into this year had been we thought you would see more slowing than you have. The PCE hasn't come yet, but the CPI and the PPI out last week were a bit hotter. Consumer spending has been stronger. Consumers are still employed, and employment has stayed stronger. So I think we've seen quite a bit of that already.
Carol, how much are you watching for, I guess, over-elevation when it comes to the tech rally, right? We've spoken to a lot of people that suggest that this is only the start of it on the back of those NVIDIA numbers. Do you think that there's a little bit too much faith in this narrative for now?
I think it's important to separate out what's going on in the economy itself as opposed to what's going on in the market. Markets like to take a story, discount it back, and get very exuberant about it in the short run, when, again, even on the upside, it's not necessarily a straight line to the upside. But the artificial intelligence build-out, the build-out of our infrastructure in the United States, and the reindustrialization, all of the investment going on in infrastructure, green grid, battery technology, semiconductor technology, that has the capacity to build a lasting, a longer than a 1 or 2 quarter sort of boost to the economy. But the market is going to be variable around that. And so some consolidation coming off, especially after the exuberance of the last 2 months of last year into the early part of this year, some backing and filling or absorption of those numbers would not be undue, and nor would it throw off that longer-term trajectory.
Wall Street does really want to see some evidence of AI in margins, as in we want to actually see some sort of profitability coming through from AI. I'm wondering how patient you think investors will be whilst companies actually start to roll out and adopt and integrate AI into their product offerings.
Unfortunately, Wall Street doesn't have a very good record of being very patient on these sorts of things. So they're going to expect to see that productivity improvement, that margin improvement instantaneously. And that's not necessarily going to come, particularly if you started parsing through some of the earnings announcements we just saw, especially the big tech companies that are investing in data centers, they're investing in the infrastructure. They're spending hundreds of billions of dollars a quarter to put that up. And like we all know, anytime you institute new processes, new technology, it takes a period of time. So being able to absorb that potential margin flattening or potentially a margin reduction for some period of time until you hit when those margins come will be necessary. But the short-term trading mentality of a lot of Wall Street isn't going to be conducive of that. But then again, it offers opportunity when you get pullbacks in those, offers opportunity for those who can adopt an intermediate or long-term mindset.
Carol, what do you like in Japan at the moment?
We actually like the broad Japanese. There's several different ways that we're playing the Japanese market in particular. There's just buying the market. And it's interesting because when you actually look at the indices in Japan, they're much more technology heavy, like the US indices are technology heavy than, say, the European markets are. And so that buoys the markets. There's also some actively managed funds that we are able to invest for our clients in that pick different industries and stuff inside Japan. But the overall market is still poised for continued gains, we think, over the intermediate and long term.
One of your themes is the reindustrialization of the US economy. I do wonder how the sort of geopolitical risk aspect weighs into that, right? Are there sort of meaningful changes that we might see if there is a change in government after November?
There is that risk out there at the margin, but then again, many of these rules that have been, or many of the laws that have been put in place that have tax incentives, that have shovels already dug in the ground, it's going to be hard to reduce some of that. But there's chances at the margin, if the projects aren't well underway, well permitted, well funded, and already started, there's risk depending on the outcome of November. There is some potential risk at the margins, but we don't think it's going to offset the trend that's there, because there are many fundamental reasons for companies to want to move manufacturing back closer. We learned many lessons during the pandemic. Whether or not we learned them at the government level, we certainly learned them at the personal and at the business level. And there's a lot of different decision making going on that it would get a boost with some government aid, but whether or not that's there, it's most likely going to continue to play out.
Carol, always great to chat with you. Carol Schleif, CIO at BMO Family Office. Well, coming up, our interview with the RBNZ Governor, Adrian Orr, after the central bank's decision to hold rates steady. We'll be, of course, getting the outlook when it comes to the economy, some of the risks to the inflation outlook. Will be joining us at 11:15 a.m. Sydney time. That's 8:15 if you're watching this morning in Hong Kong. Take a look at Bitcoin next, surging past $60,000 for the first time in over 2 years as demand widens. We take a closer look at the rally next. This is Bloomberg.
Taking a look at the price of Bitcoin here, and you're just on that continual march higher over the course of this week. So we've surpassed the 60,000 mark, and we're now trading at the highest level in about 2 years, up 3% so far just in the session today. Bitcoin, the dynamics around that, I mean, there's some of the things that are pretty well understood at this point. We had the spot Bitcoin ETS filings. Those have been approved. They've started trading. And then also you've got other things like leverage that's starting to creep back into the market after several years of dry spells. But let's get more on this and bring in Bloomberg's crypto and DeFi reporter Muyao Shen. And Muyao, I mean, I mentioned some of the factors there. There's the spot Bitcoin ETFs, there's leverage, there's the Bitcoin halving event. But what's having the biggest impact, do you think, at this point in time?
Thanks for having me today. I think the story of Bitcoin can be simply explained as like a supply and demand issue. We have this huge demand coming from Bitcoin ETFs, as well as like the anticipated demand from the Bitcoin ETFs. While on the supply side, I just think there's not enough Bitcoin available for sale at the moment. I saw some numbers that there's at least 70% of total Bitcoin supply actually has not been moved for over a year. So I think that's a pretty sort of like surprising and strong fact, as being that there's not much supply in Bitcoin.
The big question is the sustainability of this rally, right? Do you think the drivers are strong enough for it to continue?
I think, as far as what I can see, based on everything we heard from either traders or investors, that it's likely that Bitcoin may hit a new all-time high in the near-term future, which will be very unique, because in the past, if you look at the Bitcoin previous all-time highs, usually happens after the Bitcoin halving. But this time around, I think the market is kind of like predicting that it will happen ahead of the Bitcoin halving event.
And as you said, we've got that Bitcoin halving ahead. So what are we expecting out of that?
Historically speaking, because the Bitcoin halving is an event that have the reward for mining new blocks on Bitcoin. So this effectively reduces the rate at which new Bitcoins are created and enter into circulation. So in the past, Bitcoin has been sort of moved all-time high in the past. But this time, I think, again, because we have this new event of the Bitcoin ETFs creating huge demand for this asset, therefore, we're seeing Bitcoin prices going crazy even ahead of the halving event.
I'm curious, Muya, what you're seeing in terms of liquidity on exchanges, traditional crypto exchanges, given this amount of flows that's going into the Bitcoin ETFs. One of the concerns in the lead up to these ETFs being launched was that it would take traders off crypto exchanges. Are we seeing that phenomenon taking place?
I think that's a good question because usually people tend to say because all the ETF flows, meaning that the liquidity in the crypto market actually has improved much. But if you actually look at, I think a great metric to look at the funding rate on crypto exchanges, which is showing that there's a lot of leverage in the market. I think to some degree it's indicating that there's just not enough cash in the crypto market itself. So I don't think the ETF flows has really affected or has carried out an impact into the crypto market itself yet.
Bloomberg's Muyao Shen there. And you can get a roundup of the stories you need to know to get your day going in today's edition of Daybreak. Terminal subscribers can find that at Daybreak Go. It's also available on the mobile in the Bloomberg Anywhere app. You can customize those settings as well, so you just get the news on the industries and assets that you care about. This is Bloomberg. Take a look at one of the stocks that we're watching as we get into the after hours. Paramount up by about 0.4%. We did see Paramount Global, that's the parent of the likes of CBS, MTV and other networks, saying that fourth quarter sales fell 6% to $7.6 billion, accounting for shrinking advertising across traditional TV channels. But streaming subscribers did rise and the revenue came in below analysts' expectations. They're still better than expected earnings of 4 cents a share with some exclusions. Wall Street more or less forecasting a break-even quarter. Let's bring in Bloomberg Intelligence's senior media analyst, Geeta Ranganathan. So Geeta, what sort of jumped out at you when it comes to these numbers?
So it was a little bit of a mixed bag, Heidi, I think, for Paramount. So you're absolutely right with the TV numbers. They were definitely worse than feared. TV ad sales actually were down 15% in the fourth quarter. And that's a function just not of, macro challenges in the advertising market and a lot of, linear TV struggles as more and more people kind of migrate away from traditional TV to streaming. But you also had the effect of the Hollywood strikes, right? There was less content for most of these TV networks. And that, again, pushes people away from, traditional TV watching. But on the positive side, the streaming metrics were definitely a little bit better than what we were expecting. So we saw better than expected streaming subscriber gains for their platform, Paramount Plus. But more importantly, and this is a key metric that most investors are focused on, is the streaming profitability numbers. Now, in the case of Paramount, they don't have streaming profits. It's really just streaming losses. So it's how much were they able to moderate their streaming losses. And they did a fairly good job on that. But more importantly, they kind of gave some guidance for hitting streaming profitability in 2025. And that could be seen as, a bright spot.
On the flip side, Geeta, I'm curious if you've got that more people that are streaming. We also saw the Paramount's namesake film studio sort of struggled as well. So did that sort of play across into that?
It definitely did, Annabelle. So, less movies, some tough comps from the prior year. So we did see the film entertainment or the film studio kind of take quite a big hit, both in terms of theatrical. They didn't have a lot of content out there, as well as in terms of, home entertainment revenue. And then you look out going into 2024, again, those content strikes are going to have a palpable impact on the content slate for this year. So there's not a whole lot of product out there. Their biggest movie for this year, which was Mission Impossible, actually got pushed out to 2025. 2025. So again, the cotton slate looking a little bit light. So we're going to have some of that spillover get into 2024 as well.
We know that the family that controls Paramount has been weighing offers for the company. You've written some research looking at sort of these questions that are looming on its valuation.
Yeah, so the thing with Paramount is, yes, you're absolutely right in terms of all of the M&A rumors, and this has really kind of been swirling now for almost 2-3 months. Those options, though, the exit options for Paramount seem to be dwindling day by day. So just yesterday, we had some news that one of the other media players in the space, Warner Brothers Discovery, is really no longer interested in looking at a deal with Paramount. We've had some other offers, but potentially not for the whole company, only for maybe the studio part of it. And in terms of valuation, we did have one offer from Byron Allen, which was for the entire company, which was, I think, value the company at about $30 billion enterprise value. I think that is pretty much in line with the kind of way that we are thinking about the company from a sum of the parts valuation perspective. But right now, I mean, if you kind of look at Paramount valuation multiples versus some of its peers, the company is actually trading almost 50% higher versus its peers, but that's not based on fundamentals. That is completely just based on this prospect of M&A. And if something doesn't happen quickly, then those multiples are going to compress.
That was our Bloomberg Intelligence senior media analyst, Geeta Ranganathan there. Thanks very much for your time. And other corporate stories we're following today. Morgan Stanley says Rolex sales last year topped $10 billion for the first time as the Swiss brand gained market share. Their report estimates Rolex produced 1.2 million watches, with sales rising 11%. The brand's retail market share in its segment stands at just over 30%, a level Morgan Stanley describes as unprecedented. NVIDIA insiders sold about $80 million worth of stock after the chipmaker's earnings beat sent shares to a fresh record. According to the Washington service, insiders unloaded the most stock in a month since September. NVIDIA's latest results topped elevated expectations while also delivering another strong revenue forecast. Microsoft is investigating reports that its Copilot chatbot is generating responses that users have called disturbing and sometimes harmful. The chatbot was introduced as a way to weave AI into a range of Microsoft products and services. The tech firm says some users have deliberately tried to fool Copilot into generating the responses. And we'll have more to come on Daybreak Australia. This is Bloomberg.
You are looking at the Australian Parliament in Canberra there, where the Philippine President Ferdinand Marcos Jr. is set to use a rare address to Australia's Parliament to outline how the two nations intend to deepen their ties. You're looking at, of course, Prime Minister Anthony Albanese speaking there at the moment. These are defence and economic ties, and of course, all of this is against the backdrop of China's growing military presence and footprint in the region. We're expecting to hear greater detail from Marcos on his strategy when it comes to this newly struck strategic partnership with Australia, as well as his vision for the country. He is the first Philippine leader to address a joint sitting of Parliament in Canberra. He said he wants to serve as a bridge to connect the two nations. We have seen this strengthening or moves to strengthen ties with traditional security partners under Marcos with the Philippines, including the US and Australia, against the face of intensifying pressure from Beijing in that South China Sea region. Well, speaking of China, lots of focus when it comes to China's tech sector. Baidu's ADRs fell after fourth quarter profit plunged worse than expected 48%, highlighting the growing costs of training and developing AI to fend off competitors. The results follow disappointing numbers out of Alibaba too, another sign that the private sector is running out of steam. Let's bring in Brendan Ahern, CEO at Crane Shares. Brendan, whichever way you look at it, it has been a trying few years for the private sector, particularly across tech. It looked like perhaps, with the finalisation of some of the moves on Alibaba, that we were starting to turn a corner. Let's talk about Baidu first, because, is this the sort of, expenditure that investors are willing to tolerate with the opportunities of AI?
Well, I think to your point, Heidi, Chinese equities have been eviscerated as an asset class. I think the considerable underperformance relative to particularly U.S. equities has really weighed on investor sentiment. A lot of the assets have moved out of the region into India, Japan, but particularly to U.S. and U.S. technology. So I think Badu's results, they missed revenue by 15 basis points, and the stock was down nearly 8%. The adjusted net income, adjusted EPS actually did beat. And they made some progress on AI in terms of the revenues generated. Incremental, small, but certainly a start. So in general, I just think it's more indicative of a lack of interest in Chinese equities today.
Brendan, then I suppose that's the big question as to what meaningfully revives sentiment, right? Is it something that significantly boosts the Chinese consumer? Is it a way out of the property sector malaise, or is it something else entirely? What do investors want to see? Because so far policy measures have been unimpressive to them.
Yeah, we've not seen a proverbial policy bazooka. Certainly, ultimately investors want to make money, and capital flows to where it's treated best. And I think there's an effort to repair some of that trust. I think there has been a change in the tone and tenor out of Beijing to foreign investors, foreign corporations. There's clearly an effort to stabilize the mainland Chinese market. But I think investors want to make money, and certainly buybacks, dividends, but more IPOs, if it's Shein or Ant Financial or Temu being spin out of Pinduoduo, or certainly ByteDance IPOing TikTok. If investors are making money, they're willing to put up with a lot. And at the moment, we've seen a small rebound over the last 10 days. And I think hopefully that little trend does continue, that if we can make money in China, more money will flow back in.
Brendan, where do you think then, in terms of looking at China's tech sector, where do you want to be betting at this point in time? Do you want to still focus on sort of those more the big private names, Baidu, Alibaba, Tencent, JD, or do you want to be moving more into more state-backed firms instead?
I think there's an argument, certainly in the short run, that mainland state-owned enterprises are beneficiaries of state intervention, if it's Central Hujian or other members of the national team buying Chinese equity ETFs. At the same time, for foreign investors, they're always going to gravitate to the growth sectors, the consumer discretionary, technology, communications, the names that really that they can resonate with. It's easy to say Baidu, Google, Alibaba, Amazon. And so I think investors will always gravitate to these growth gear names as opposed to the slow, no growth sectors, despite very high dividend yields.
And in terms of the geopolitical overlay into all of this, what are we sort of expecting from China and from the likes of, say, NVIDIA, for instance, who have sort of been re-gearing some of their chips to meet that demand from China?
Yeah, certainly. I mean, Chinese, their export-driven manufacturing, if it's PlayStations or iPhones, that requires chips for not necessarily domestic use, but for part of that export-driven manufacturing. So I think there is a move from the Biden administration. Corporate America does have a say in U.S. laws and Washington, D.C. And so a very profitable company like NVIDIA, no different than Apple or ExxonMobil or Nike, Boeing, which are highly geared or have very high revenue exposure to China. The U.S. government is going to go out of their way to hurt those companies. There's a lot of bark in terms of media, but there's not necessarily a lot of bite. And even President Trump, there's a lot of talk about tariffs, but we all know Walmart paid that tariff bill. Chinese companies didn't. That's passed on to U.S. consumers and is inflationary. So it's good political TV fodder, but economically, it hasn't really hurt China in a overly prescriptive way, at least thus far.
Brendan, thanks for your time. That was Brendan Ahern, their CIO at Crane Shares. And amid insatiable demand for AI chips, Bloomberg Intelligence sees the global semiconductor manufacturing market nearly doubling in the next 8 years. A handful of chip tool makers are also set to dominate key technologies. Let's get more from Asia-Pacific technology analyst Masahiro Wakasugi. Masahiro, how will the chip-making equipment market change by 2032?
Yeah, we analyzed that the chip-making equipment market in 2032 could almost double from 2023. And this is because chip makers will aggressively invest, and the chip capex will also chip making equipment market will be, almost doubling because of the chip maker will almost, double the capex, and in order to expand the production capacity and for the next generation chips, for logic chips or maybe NAND chips or DRAM chips. And if we based on our upside scenario analysis, we could have the market could be almost 2.5 times as much in 2032 compared with the 2023. And now we are seeing the very strong demand from the artificial intelligence chips. So I think that the chip making equipment market should be a pretty interesting and promising market going forward.
What about the competitive landscape?
Yes, we think that the competitive landscape for the chip making equipment suppliers should be continue to be quite favorable. And it's a pretty interesting market. And if we look at the specific products, for example, lithography tools, ASML dominates around almost 90% of market share. And if we look at the quota developer market, Tokyo Electron dominates 90%. So I think that the chip making tool market will have a favorable competitive landscape, and this means that they can generate quite high operating profit margins, say in 2032. We think that including ASML or maybe Tokyo Electron or KLA, top 5 or 6, 7 companies will generate, say, 30 to 40% operating margin because of this competitive landscape.
Bloomberg Intelligence Asia-Pacific technology analyst Masahiro Wakasugi there. Bloomberg is also at the World Trade Organization Ministerial Conference in Abu Dhabi, and you can catch our conversation with the US Trade Representative Catherine Tai later on Thursday on Bloomberg Surveillance. More ahead here on Daybreak Australia. This is Bloomberg.
Hong Kong's real estate sector is facing an uphill battle even after the government's most forceful attempt yet to revive the market. Authorities have eased homebuyer levies and mortgage lending restrictions as part of sweeping measures to revive the financial hub. Our China economy editor Jill Deesis joins us for more. And Jill, this is one of the sort of key takeaways from the Hong Kong budget address yesterday. We saw developer shares really showing that market watchers were a little bit surprised by that full elimination. But is it really going to be the sort of cure for the woes of the real estate sector?
Yeah, I think that at this point, the problems within Hong Kong's property market are just still so severe. Now, these are curbs that were introduced in the aftermath of the global financial crisis. The idea was that at the time, interest rates were plunging. They really needed to cool home buyer demand down, but they've existed for so long because that just really hasn't happened. I mean, Hong Kong is still world's least affordable housing market. And so, but at the same time, you're still having all of these issues with the home buyer demand now. So ultimately leading to these property curbs to be removed. Obviously, as you mentioned, markets weren't expecting something that was this severe. But at this point, when you've got interest rates as high as they're remaining in Hong Kong right now, it's difficult to see how this leads to ultimately a longer term improvement within the local property market. So I think what a lot of investors are looking out for right now is whether you see sort of any short-term gains. I think we have to look to see what happens with, any future property sales that come on the market. But at this point, it's just really not clear that this is going to lead to any sort of long-term sustainability within the Hong Kong housing market.
how strong is a correlation between whether or not we see a sustained pickup in the Chinese economy? Be it you talk about the malaise across the property sector, tourism, retail slowdown as a result in Hong Kong. Is that really the crux of when we'll see a recovery for Hong Kong?
Yes, I mean, I think you nailed it. At this point, this economy is incredibly tied to what's happening within the broader Chinese economy. We saw this during the pandemic in particular. I mean, obviously Hong Kong had a lot of its own issues with sort of isolating itself from the rest of the world during the pandemic, but also the slowdown in growth that we're seeing within China's economy feeds into some of these broader concerns. Right now, Hong Kong is trying to deal with a bunch of other headwinds. Tourism in particular is a massive issue. You've seen a big drop off over the last several years. This budget that Hong Kong announced just yesterday did include some measures to sort of have tourism pick up again. Really remains to be seen how much that's going to play into it. But when you've got, sort of a lack of visitors from mainland China in particular, a major key source of tourism revenue for Hong Kong because of some of these broader issues with China's, eroding wealth within the middle class. I think that it's going to be, kind of difficult for Hong Kong to actually see a meaningful turnaround. We've seen them forecast growth of around 3.2% over the next several years. We'll see whether that comes to fruition in Hong Kong.
Our China economy editor Jill Desis there, and you can get an insider's guide to the money and the people shaking up the finance hub in our new Hong Kong edition newsletter out every Thursday. You can sign up via bloomberg.com/newsletters. Well, the Philippine President Ferdinand Marcos Jr. is addressing a joint sitting of the Australian Parliament as part of his state visit to the country, that's taking place at the moment in Canberra.
It has become crucial for us now to envision the shape, the breadth, and the depth of our strategic partnership and how it must move forward as we weather the storms of global volatility.
Let's get some more analysis on this from Bloomberg's government reporter Andrea Colonzo joining us now. So we've seen a strengthening of these traditional alliances with the likes of Australia and, of course, the US as well under Marcos. Is there a sense of urgency to build these relationships, in light of a more assertive Beijing?
Yes, definitely, for sure. And Marcos's speech is expected to center on that. That's one of the aspects he highlighted in the early part of his speech. So he said that the security of Australia and the Philippines are very much intertwined. So in the face of so much tensions, especially in the South China Sea that we're seeing, so Marcos is expected to highlight and provide more detail into how much or how to further deepen security ties with Australia. Another aspect that he said he wants to do is also to try to bolster economic ties with Australia. So he's aware that security ties or the security relationship between the two countries should also come with a deepening of economic relationship. So he would also seek to detail ways on how to improve trade and investment ties between the two nations.
And on that point, Andrea, as you say, we've seen Canberra trying to boost its relationships with countries that are in Southeast Asia. We've seen the Philippines looking to strengthen ties with traditional security partners. But how have those, in a practical sense, how have those expanded relations really played out over the last year or so?
Yeah, so as a background, so Australia and the Philippines have elevated their ties to what is called strategic partnership. So in concrete terms, so we have seen the Philippines and Australia conduct joint maritime patrols in the South China Sea. So this is a big step because it shows how interconnected their military is. There are also efforts for Australian soldiers to join military drills in the Philippines. So also, Australia has pledged to support the Philippine Coast Guard, which is in the forefront of recent clashes in the South China Sea with Beijing's vessels. So they have Australia has pledged to support the Philippine Coast Guard in terms of drones and having more awareness in South China Sea. So these are just of the few steps that we've seen being taken by the two countries, and in the past year, and we expect measures like this to be stepped up, to be bolstered with the elevation of the ties between the two countries.
Bloomberg government reporter Andrea Colonzo there in Manila. Some of the other political stories that we're following this hour, US congressional leaders have reached a deal to avoid a partial government shutdown. The agreement on a full-year funding package clears the way for Speaker Mike Johnson to allow a vote before a Saturday deadline. Republican leaders are backing the deal despite the risk of a backlash from conservatives demanding new immigration restrictions. Republican Mitch McConnell will step down as his party's leader at the Senate after the November election. The 82-year-old has been in the chamber since 1985, leading Republican senators for more than 17 years. His departure sets up a fierce succession battle set to be driven by loyalty to Donald Trump.
I have the honor to represent our states and do the important work of our country. But Father Time remains undefeated. I'm no longer the young man sitting in the back, hoping colleagues would remember my name. It's time for the next generation.
A New York appeals court has denied Donald Trump's request to temporarily delay payment of the state's $454 million verdict against him. That's even after the former president said he may be forced to sell properties to cover the judgment. Separately, the US Supreme Court says it will rule on Trump's bid for immunity from criminal prosecution. Trump has been pushing to delay any trial until after the November presidential election.
Well, Heidi, just bringing our viewers' attention to some breaking data coming out now. We've got industrial production numbers that are dropping for Japan. And on the year-on-year level, we're actually seeing the number coming in a little bit better than what had been expecting. So we were foreseeing a drop here of 1.6%. That was what the survey had suggested. It's actually come in at a contraction of 1.5%. What's really playing into the numbers over the course of January is auto production. It was a period where we had a temporary production halt by Daihatsu Motor. That's a Toyota subsidiary that makes light vehicles, and that was over a safety scandal. So those auto production issues could have been playing into the figures. But as I said, industrial production on the year, contraction of 1.5%, a little bit better than economists had been expecting. On the month, though, we did actually see it going past the estimates here, so a contraction of 7.5%. The survey reading had been for 6.8% contraction. That is the industrial production side to it. Our Bloomberg economics team, it's worth noting, they are saying that we could expect production to pick up over the course of February because Daihatsu has resumed its operations. We know that from yesterday. And we are seeing better demand for Japanese cars abroad as well. So something that's playing as well into the semiconductor cycle that's also boosting production through exports there. So that's the industrial production. You're seeing retail sales here on the year, and that actually was better than what economists had been expecting. So that's the reading there. Year on year, up 2.3%. The survey had been for 2% on the month as well, better than what economists had been seeing. So gains of 0.8%. The survey had been for 0.5%. So again, it just points to those figures. Perhaps, yes, Japan's in a technical recession, but still we are seeing some stronger data points coming through. We'll have more ahead on Daybreak Australia. This is Bloomberg. Taking a look at crypto prices here, and you've got Bitcoin just pushing back to that 64,000 mark. It nearly touched overnight, but Bitcoin really the focus over the past few sessions here, given that rapid ascent we are seeing. What's driving it? Well, it comes down to, yes, what triggered it was the spot Bitcoin ETFs. We're seeing demand for those, but also it comes down to the supply demand dynamics of the sector as a whole, because given that move into those ETFs, you're seeing a lot of demand for the tokens, and that's outstripping the supply of new coins that are being issued or created in the mining process. You've also got leverage that's re-entering the crypto market, and we haven't seen that, Heidi, for several years in the digital asset space. Certainly a dry spell. Question, of course, always with these sorts of fast rallies is how permanent are they?
Yeah, and we were talking earlier about, just how much really the fundamentals have changed or maybe haven't changed when it comes to this asset class. And but we're, about 11% away from a record high for Bitcoin, how quickly things have turned in this recent run of bullishness, if you will. But take a look at what we're watching when it comes to currencies around the region. We're seeing the Bloomberg dollar off, look pretty flat at the moment. We have seen, though, some pretty robust dollar gains ahead of the key inflation data as the Fed really highlighting their scrutiny of eco data. We're seeing a lot of weakness there for the Kiwi. Speaking of which, our interview with the RBNZ Governor Adrian Orr is coming up next.